This is Stakepool TeamSpeak recording Bitcoin trading and taxes. You wanna be a Bitcoin trader? Try paper trading first. There is a 20 Bitcoin reward for the best paper trader. Just go to fgc.stakepool.com and sign up for free.
Okay, we have joining us now Dan.winters of Global Tax Accountants, who advises clients. He specializes on cryptocurrency related accounting issues. So he's here to give a presentation on his normal sort of presentation, where he goes through the typical issues that are facing people in Bitcoin, Ethereum, and other crypto related issues. And you guys have given a list of good questions. And so when anything pops up that relates to some of the questions that we already have been given, me or one of the others will chime in and present this question to Dan, who will then address it to the best that he can. But just keep in mind, his area of expertise is tax. He's not a lawyer. He can't advise on regulatory matters if they're not regarding tax implications. So try to keep the questions as relevant as possible in that regard. But I'm going to give the floor now to Dan.Winters of Global Tax Accountants. There you go.
Hey everybody, how's it going? I just want to thank Swapman and BTC Vex and some other members of the crypto trading community for inviting me to give this talk today. This sort of started last spring, actually. I was at Inside Bitcoins and just happened to bump into a group of traders. Some of them may be here online today, I'm not sure. I haven't gone through all the names there. But they asked me to come and give a talk on, what does it mean for tax purposes when you are buying and selling Bitcoin and other digital currencies. So I did that last summer, and looks like we're making it an annual event. Before we get moving, I'd just like to kind of give you a brief introduction about myself. I'm a tax accountant. This is my specialty. I've been in this field for about 15 years. I really first found out about Bitcoin. It caught my attention in late 2013. I think everybody knows what was going on with the price at that point. I think that year we went from $10 a coin all the way up to $1,000 as part of that well-known Mt. Gox situation. But so that's how I first heard about Bitcoin, and I got real interested because this is revolutionary stuff. I began doing a couple little experimental things, coin here and there. And then 2 years ago to the day tomorrow, actually, on March 25th, 2014, the IRS issued a notice stating this is how you need to treat Bitcoin for tax purposes. And frankly, I was kind of relieved because now I knew what to do with the transactions that I was doing myself. By the end of the year, I had made a decision that Bitcoin is an important enough trend and technology that I pivoted my whole practice to focus on the whole Bitcoin and blockchain ecosystem. So it is not by any means the full amount of how I spend my time, but it is by far the most interesting thing that I do in my professional life. So I just wanted to give a quick intro.
Great, and let's start first. Then, can you say, has there been any developments on IRS policy or general tax policy globally relative to Bitcoin and cryptocurrencies since you last came on? Has there been any news that you can tell us from your expertise?
Thanks. Well, actually, the fact is that the IRS issued that notice 2 years ago tomorrow. And in fact, that's all that the IRS said. The Financial Crimes Enforcement Network, FinCEN, has also provided some information on those responsibilities, specifically to foreign bank account reports, which I will get to. But no, in fact, there have been no big changes since that notice came out 2 years ago tomorrow.
And have there been any sort of developments in, has the IRS sort of gotten more specialty in training on crypto issues, or have there been any kind of large cases involving people involved in cryptocurrency? Has any of those things kind of popped up lately, or?
Excellent question. I think what I'll do, because I will certainly address that, but I thought I'd sort of just begin with a general background about who is it that regulates Bitcoin in the United States, and I also have a disclaimer that I want to discuss, and then I'll kind of get into the details of the IRS notice. The first thing is my disclaimer, which is going to be number one. I'm only going to be discussing the United States federal taxation of Bitcoin and what the IRS terms virtual currency. We have 50 different states. All but a handful of them have their own set of income tax laws, so I'll be addressing only federal taxation. The second thing, of course, is that I'm providing general information, based on what the IRS has said to us and other publicly available information. Everyone's situation is unique, so before you go and file your tax... Okay, sorry. Anyway, just a general comment that I'm providing general information. Everyone's situation is unique, and that you need to essentially speak to your accountant or tax advisor before you would act on any of this. So, who regulates Bitcoin? Well, quite a few governments and government agencies. In the United States, Bitcoin is regulated by the federal government and by the state government. Specifically, it's regulated by the Internal Revenue Service, which is what we're going to talk about today. Now, as I said before, we've got 50 different states, and almost all of them have a state income tax. Nonetheless, very few states have issued specific guidance on the taxation of virtual currencies. Those states would be New York and New Jersey, where I live myself. FinCEN, the Financial Crimes Enforcement Network, has issued several rulings that are concerning virtual currencies. These are not tax related, though. These are more issues concerning money transmission, but I kind of want to just kind of provide a general background of the various parts of the U.S. government and their role in regulating Bitcoin. One thing that made a big splash last year is that FinCEN fined Ripple Labs $700,000 for violations of the Bank Secrecy Act and for failure to implement and maintain an adequate anti-money laundering program. So FinCEN is quite aware of Bitcoin. They've issued multiple rulings about this, again, in the area of money transmission, anti-money laundering, Bank Secrecy Act. Additionally, some of you may have heard that the Commodity Futures Trading Commission, or CFTC, has ruled that Bitcoin and virtual currencies are commodities, and that therefore that agency regulates Bitcoin derivatives trading. Now, to dig into that statement a bit, the CFTC says Bitcoin derivatives are regulated by the CFTC. So what we're looking at here essentially is the same exact digital asset, Bitcoin, is treated as a derivative by the CFTC and treated a different way by the IRS. To make things more complicated on a global, international level, each country in the world has their government, has their rules. The laws on Bitcoin are different from country to country. So national governments regulate Bitcoin, as well as different national courts, in particular in the European Union. So I kind of want to just give a general background there before we dig.
Okay, that's a good foundation. But are you still able to, regarding the disclaimer, are you still able to make at least some discussion about sort of hypotheticals about tax issues affecting non-Americans? Or
As far as tax uses for non-Americans, the fact is that the Masters of Taxation that I have is in U.S. tax law, so I really am not qualified to speak about non-U.S. tax issues.
Okay, that's no problem. It's just so that people know. But okay, you can begin with your presentation however you would like.
Okay, so 2 years ago, on March 25th, 2014, the IRS issued a notice, 2014-21. That notice defines virtual currency and describes how Bitcoin and other virtual currencies are treated for federal tax purposes. Okay. And I'm going to give you the official definition of a virtual currency. And I know that, frankly, no one but the IRS and FinCEN uses the term virtual currency, but that is their term and we have to basically speak their language. So, according to the IRS, virtual currency is a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. Well, that sounds like Bitcoin to me. They also go on to say that virtual currency that has an equivalent value in real currency, or that acts as a substitute for real currency, is referred to as convertible virtual currency. Again, this sounds like Bitcoin to me, but frankly, we already have a problem with the definition because they never say what real currency is. But that is the official definition. The biggest takeaway from the IRS notice is that virtual currency is property for federal tax purposes. Virtual currency is not treated as currency. It is treated as property, and therefore the consequences of buying and selling a virtual currency. Swapman, is there any way to mute the people going in and out of the channel? Because that's probably getting recorded too.
No, it's actually not being recorded on this side, but you can just go to self and then disable sound pack.
Self.
And then go sound pack and then the sounds deactivated. Yes.
Thank you very much.
Sorry about that. I thought we had that set up before. Sorry about that. You continue though.
That's fine. So as I was saying, the virtual currency is property for federal tax purposes. What this means is that the general tax purposes that apply to property transactions, they also apply to virtual currency. Okay, so let's get into the meat of this now. If a taxpayer receives virtual currency as payment for goods and services, you must include the fair market value of that virtual currency into your income. That fair market value is the US dollar value of the virtual currency on the day of receipt. So the IRS is fairly clear. Income from, let's just call it Bitcoin, because virtual currency is just a geeky government term. Income from Bitcoin is income, and the key issue is looking at the US dollar of that virtual currency when you have received that Bitcoin. They do discuss the exchange rate, and there's a rather long sentence here that I won't quote in full, but the key takeaway for the exchange rate is that it should be in a reasonable exchange rate that is consistently applied in a reasonable manner. Now, why do I bring up the exchange rate? Well, as traders, I think you all understand that Bitcoin can be quite volatile, moving 10% or even more sometimes in a day. So at the, well, what rate are you supposed to use? Now, essentially, there are multiple sources on the internet that will give you the average exchange rate for any given day, and you should therefore be consistent in the exchange rate that you're using in order to calculate your gains and losses on your trade. Again, they do not demand a particular rate, but it should be consistently applied in a reasonable manner. Essentially what that means is, excuse me, pick one rate and use that rate. And what the background here, of course, is for tricky things like, well, what about when you trade in, within the day and you buy Bitcoin at 400 and at the end of the day you sell for 425. So the average rate is, 413. Well, since you're trading within a day, you're really going to have to use the spot rates to determine what your gain or losses on your trade. But that's a specific situation, but kind of just wanted to throw that out.
And so if you're making a purely Bitcoin based trade, say on the futures market, and you earn a P&L in Bitcoin, you're saying for US tax purposes you actually have to record that the value of that income on that day in the USD spot market value of the Bitcoin.
Well, I didn't want to get too much into futures just yet, and I probably won't get that deep into futures, but the key takeaway is that when you are transacting with Bitcoin, the IRS doesn't speak Bitcoin, doesn't speak Ether. Everything gets reported using the US dollar value of these transactions.
Okay, so then it has to be basically the daily P&L has to be reported in USD terms on that daily spot price, more or less.
More or less. Again, kind of the takeaway, and I'm not speaking specifically to futures, but all the transactions have to be reported in dollars. And when you're talking about the reporting the trades, the data points are the data purchase, the purchase price of the Bitcoins in dollars, the data sale, and the sale price of those Bitcoins in US dollars.
Okay, so there's no, for example, you wouldn't be able to just sum up your Bitcoin profits over the year and then apply some average over the year and say that's how much it was. It's actually on a day-by-day basis.
That is correct. You cannot average it, and that's simply, and obviously that will be a lot easier, but unfortunately, no, that's not the way it works. And this is no different than, remember, what we're really doing here is we're taking the existing rules for other types of property that are bought and sold, like stocks or bonds, and we're applying these same rules to Bitcoin, which is just a new form of property. So it's similar in that, well, what if I'm a day trader or I'm a full-time stock trader, and every day I am buying and selling U.S. equities, say. So I have to keep track of each one of those transactions on a daily basis.
Okay, yeah, that sounds reasonable.
Thanks. Sort of just move on here. So I was kind of talking about the rate. Okay. Let's talk a bit about, again, going back to sort of the basics here. The basis of the property that you have is your original cost plus your acquisition cost, such as commissions or fees from exchanges. And again, the IRS is taking existing rules for property, such as stocks or bonds or other types of property, and in their notice they said, here's what we have to say about a number of specific situations, and the existing body of tax law applies to everything we didn't mention specifically. Okay. So again, the basis is your cost plus your acquisition cost, which could be commissions and fees. Okay, now here's what I think people have been waiting for, which is, well, how do you calculate your gain and loss when you exchange Bitcoin? And in essence, the rules are fairly straightforward. The practice can be a lot messier due to issues with records. But what we have here is, if the fair market value of the property that's received in exchange for the Bitcoin exceeds your cost basis, for that Bitcoin, you have a taxable gain. If the property that you receive in exchange is less than the cost basis, then you have a loss. Basically, you're up or you're down. Now, sorry, as far as what you might exchange your Bitcoin for, it could be you can sell the Bitcoin for a real world currency like dollars. You could exchange this for property, or you can receive this for services. All of those things are a taxable event. If I have $100 of Bitcoin and I go and buy a ticket somewhere, or something like that, that's a transaction. If I receive a property in exchange for my Bitcoin, it's also going to be a transaction. Or if I receive the property I get is money, dollars, again, that's a tax. Any questions?
Yeah, well, I back to this, what you mentioned about the data points that have to be reported. Are you saying that day traders generally, and that they have to report every single trade that they make?
Yes.
So every single, like, even if it's just one little contract you buy, you sell, that has to, if you have that, you have to report that every single bit. Even if you're losing money, even no matter you're profitable or not, you have to report this annually.
Yep. I know that was a short answer, but again, we're going back to how things work on the stock market and sales of equities or bonds. The sale of, you can have a stock sale for, $500,000, say. It's not unusual at all, and I've seen these things on tax returns over the years. But sometimes the way the trades go, the shares don't all get sold in a block, and then you end up with, $3 of cash in lieu that comes out in a trade, and the $3 has got to be reported on your taxes.
And maybe this is getting a bit too far ahead, but how about if you have a loss on a year? Can you go through how the carry forward rules work, or is that getting a bit too far ahead?
No, that's fine. I mean, I was gonna get into it. Yeah. So the answer is all of the trades are reported, whether they're gains or whether they're losses. For federal tax purposes, the losses offset your gains to the extent of gains. If your losses are more than your gains, you are allowed to deduct $3,000 a year for federal tax purposes. So if at the end of the year, you calculate all your trades, you have a $5,000 loss, you can take $3,000 of that loss, and the $2,000 is carried forward to the next year, and the losses never expire.
Okay, so the losses, you can carry, then if it's 10 years in the future, you can still use the loss to offset the gain.
That's absolutely correct, and it is one of the good parts about the IRS loss carry forward rules. The losses from the exchange of capital assets, they never expire. The bad news is if you have no other gains, you can only take $3,000 a year. We are taxed on our worldwide income. So what that means is regardless of where on earth that income is generated, whether that exchange is regulated, non-regulated, whether they're telling anybody what you're doing, whether in the case of BTC-E, we're not even really sure where the exchange is located, doesn't matter. Your legal responsibility as a U.S. citizen or green card holder is to report your worldwide income. So it needs to be reported. Period. But to go to your question about, well, what are the data points on the tax return? There's a schedule where you report the cost basis, purchase date, the amount of the thing you sold, the Bitcoin, the number of coins, the date of sale, and the sale price.
So in that sense, the name of the exchange doesn't even come into play unless you're getting audited or there's some other scrutiny coming from the IRS itself, right?
Well, what I was going to say is I don't think it will be mandatory to report where the exchange was. I mean, simply put, I don't think the IRS really cares. They want you to report your income. There are a lot of forms of income where the IRS does receive an official data feed of exactly what occurred, and that would be, for instance, with a W-2, with a 1099 form, if you were a contractor. I'm sorry, I know that you're European, so a W-2 form is the form that your employer sends you for your wages for the year, and a 1099 is if you're an independent contractor. So the IRS also receives data feeds for every single stock trade that occurs on a U.S. market. But the schedule also lists a place to put information that was not reported to the IRS. And this is because the IRS doesn't get a data feed for every transaction because there's just not a system in place. And if we can step away from Bitcoin and crypto for a moment, well, let's say that you're someone who's a private coin collector and you've been gradually building up a collection of gold and silver coins, and you keep them in a safe in your basement, and at some point you decide, gee, this is really appreciated in value, so you go and sell it, okay, and you get paid for this. Well, the IRS isn't going to necessarily receive a record of this private sale that you did. However, it doesn't matter. You're still required to report it. And there's a special 28% collectibles rate for the sale of gold.
But the IRS is not going to make Bitcoin or cryptocurrencies have this collectible loophole anytime soon, I reckon.
No. That's correct, because Bitcoin does not. It doesn't fall into that category. It's not a collectible. That collectible rate, that 28%, is only for gold and other items like that, like artwork, things of that nature. Which kind of gets us into a good thing of, well, what are the rates and just how do we calculate what our gain is going to be here? The important thing here is if you have a short-term gain or a long-term gain. So I'm just going to throw in a quick example. So somebody buys one Bitcoin for $250 on April 15th of 2015. On May 23rd that same year, they sell that Bitcoin for $300 of cash. You have $300 of proceeds minus your $250 cost basis. You have a $50 short-term capital gain. Fairly straightforward, and the difference is in the tax rates. For a short-term capital gain, you are taxed at ordinary income rates that go as high as 39.6. However, for capital sales of more than a year, you have a lowered rate of usually 20%. It kind of depends on your tax bracket. But so if you had bought that Bitcoin on March 15, 2015, and then didn't sell it till March 16, 2016, you're going to have the same gain, but you are going to get a long-term capital gain, and you're going to have a rate that's going to be a max 20% as opposed to going all the way up to 39.6. Okay.
So, is there any kind of method to reduce those gains? Like, I know these private equity guys, they have these carried interest loopholes and stuff that they can use to pay like even less, lower rates of taxes. Is there any kind of setups that traders can do to minimize this, like using any sort of completely legal, of course, sort of avoidance methods?
Let's be careful about using the word avoidance. What we can talk about is tax planning.
Okay, planning. Well, yeah, perfectly. What I mean is perfectly legal methods for like carried interest, like the private equity guys have, and this sort of methods.
Okay, so to explain the concept of carried interest, essentially this is a very specific rule involving the compensation of hedge fund managers, private equity managers, such that they have money that they are managing, which frankly most of the time it's not even their money. They don't literally have skin in the game. But there is a portion of the tax code that states that the compensation that they receive from that very specific type of activity is taxed at a long-term capital gains rate rather than ordinary income. The net effect of this is that someone can make $1 million, and instead of being taxed at a 39.6% rate, it's only 20%. So it's a nice situation for the pretty small amount of people in the United States who fall into that category.
And there's no kind of setup that the traders could utilize in a similar manner in order to get some kind of similar treatment as these guys?
Not that I'm aware of, no, because I think the only way that would possibly work would be if someone created a fund that was holding and buying and selling Bitcoin, and that the investment managers on that fund were therefore compensated in the form of carried interest, and then those investment managers would receive compensation that would be taxed only up to that 20% long-term capital gains rate. So, I mean, theoretically, I suppose it's possible, and probably have to ask the Bitcoin Investment Trust how they're paying the handful of people that they have doing their trading. And in fact, I mean, anyone care to fill me in on the full details of that? There's only one security in the United States, I believe, that is backed by Bitcoin and that is traded, even though it is on pink sheets.
Yeah, well, I mean, there's an ETN as well in Sweden that's listed in Sweden, and there's a couple of other products. But so is there any benefit though at all with setting up a sort of a separate entity and trading through the entity rather than your personal? Aside from the legal liability stuff, is there any sort of tax specific benefits to operating through an entity rather than yourself as a trader?
Actually, there can be, but it would really have to be a partnership. I mean, and I have issues like this on my desk. There is someone that I know who I have a partnership whose return I prepare. I started doing it last year, which are two individuals who buy and sell Bitcoin. Now, here's what the big difference is can be in the treatment of your expenses. Because your investment expenses, and this gets a little technical, but there's two ways there are two ways that you for your deductions for an individual tax return, a 1040. You can either itemize your deductions, where you add up all the different types, or you take a standard deduction. Okay. For a person who is only taking the standard deduction because, say, they're a fairly young person and they don't own a home, they're not paying a mortgage and real estate taxes, which are the two biggest parts of an average person's itemized deductions, you're not really going to get the benefit of your investment expenses, and I'll explain why. The two main when you look at schedule, and again, this is getting fairly detailed, but that's fine. You have a Schedule A, and there are certain items on there that you can deduct from your income. For most people, the biggest items are the mortgage interest you pay and the real estate taxes you pay and your state income taxes, which in a high-tax state like where I am in New Jersey or New York, those numbers can get pretty large. There is most of those deductions can be deducted 100%, but there's income limits, but I'll skip over that detail. There are also expenses that are called miscellaneous expenses subject to the 2% limitation. So what does that mean? It means there's a whole category of expenses, including investment expenses, which is how we got to the question. You can only deduct the amount of those expenses, which is more than 2% of your income. So if you have a trader that made $100,000 trading Bitcoin and they are out there, any investment expenses you had, such as you're paying for computers, you're paying for services to provide data to you, you need to spend some money to make money, right? I'm not talking about the cost of acquiring the Bitcoin. I'm talking about your other expenses you need to operate. Those investment expenses, if you have an income of $100,000 a year, those investment expenses can only be deducted if they're more than $2,000 for the entire year. I know I went off into a great deal of detail, so I'm going to kind of take a break.
No, I think that was actually I was going to finish that thread on exactly that question regarding, because a lot of people here are making their living trading Bitcoin daily, and they do itemize their deductions, right? And so they're trying to understand the full range of what is allowed to be deducted as part of this. So, how can you maybe speak a little bit more around that? You mentioned news feeds and this kind of stuff, but how broad does this really get? How reasonably are the limits set?
I guess the question is that the investment expenses, they're not really that broad. I'd kind of have to go pull a publication right now to state what some of them are. In a more common scenario, an investment expense would be someone who was paying an investment manager to, a 2% fee a year to manage their money. There's another category called investment interest expense, and I've looked at that for Bitcoin traders as well. I think we all know it's not uncommon to borrow Bitcoin, probably at a fairly high rate of interest, then take that Bitcoin, trade it up, and then pay the Bitcoin loan back plus interest. So if you're borrowing Bitcoin for investment purposes, and then you pay interest on that Bitcoin, you then have investment interest expense, which could be a deduction, keeping in mind that you have to translate the amount of that interest paid throughout the year into dollars so that we can get to a number the IRS would understand.
So you could also then write off the fees, the commissions that you're paying, and these kinds of things as well.
Well, the fees that you're paying toward the exchanges and those commissions, that's really going to end up being part of either your cost basis or the proceeds that you receive on a trade. So they're probably not going to end up being broken out separately.
But if you're borrowing the funds to trade, this margin expense, you're saying, can be served as both. You can use it to offset the cost increase the cost basis and reduce the amount of taxable gain, but also you can write it off as this interest, investment interest.
Okay, yeah, thanks for clarifying that. So I'm going to change my answer because I didn't fully understand the question. So, yeah, I was talking about I answered the wrong question, and I answered the question of what about the expense, the commissions you have when you're purchasing Bitcoin, and I said, well, those end up going in your cost basis. But the question that was asked is, well, what if you borrow Bitcoin on margin and you have to pay a fee to the exchange to do that transaction plus the interest? The answer to that would be a very different answer, which is you've now got an investment expense and you've got investment interest. I would have to dig into that one pretty deeply to get a real good answer on it. But conceptually, that's the way it would work. That you've now got investment expenses because you're paying that fee there. But again, the rule. The part that seems pretty clear to me would be investment interest expense, because you borrowed, let's make it easier, you borrowed $100,000 US on your US brokerage account and paid margin interest, and at the end of the year you had paid a total of $5,000. You have $5,000 of investment interest expense and you paid the money back. You can do that with Bitcoin. you just have to translate everything to dollars, including every interest payment that you make, convert into dollars, and come up with an aggregate number. Going back to the question of, well, what about the fee that you pay when what the exchange charges you to do the margin? I'd have to take a hard look at that. I suspect there would be a deduction in there, but I would definitely have to do some research on that one.
Okay, and to take a different turn now, since we've discussed these itemizations quite a bit, and how about an issue a lot of people are asking is, let's say that the government knows that you have bitcoins in a certain address. How would they know whether or not you have lost the private key and therefore no longer have these coins? How would if they say you owe us money for this and you say, well, I lost the coins, like I don't have the key anymore. How is this treated because there's actually a lot of people who legitimately have lost their coins and they're wondering, can this be used in some way to offset taxes later or anything like that?
That's a good question. As far as, how would, the IRS know that someone had lost their private keys? I think you can answer that question yourself. But to get into the details of, well, how are you supposed to report it when you've lost bitcoins? The answer is this could potentially be a loss. I did face a situation with someone. I did do the research, and the answer was yes, it was a reportable loss. But we need to look at the facts and circumstances here. There's a difference between an exchange being hacked and your coins being stolen, and a situation where you're a trader on local bitcoins and you sold somebody Bitcoin using PayPal, and then they stiffed you because they did a chargeback, and then PayPal clawed the money back from you. So the facts and circumstances are different. In one case, it was essentially stolen because the exchange was hacked. In the other one, it's less clear what happened. But the main issue is, yes, you can report a loss on Bitcoin that you have somehow lost access to. The key question here, is it going to be a capital loss, or is it going to be a loss against ordinary income, and very different rules apply. But you could do it, and I had to look at this once.
So can you try to give a better idea of where that line is? Let's say somebody is a plumber, and they like to take a lot of their income in Bitcoin, and for the year they've taken in, let's say, 100 Bitcoin. And then let's say, unfortunately, he's got a paper wallet, and that's where he keeps all of his money, and he lost it, unfortunately. He doesn't have the key anymore. Does he still have to pay the income tax on all of that? Does he still have to, does that become like a capital loss that he can carry forward indefinitely? And how would a situation like that be treated, for example?
Well, it's sort of one of these other answers that you get a lot in tax, which is it depends. And you asked a multi-part question. Well, if the plumber if the plumber's clients were paying him in Bitcoin during the year, you have to pick up the U.S. dollar value of that income on the day it's received. If the keys are later lost, okay, you can have a loss on this potentially, but you can't ignore the income you received. Conceptually, it's not that different from somebody goes to the bank and deposits a check. They then go to the ATM machine, they take $500 out, walk down the street, the wind blows up, and their $500 is scattered to the wind. They lost $500. You still have to pay taxes on the income you received and you put into the bank with a check. The fact that you lost that money later on is treated as a separate transaction.
And then, okay, so you're still on the hook for the income tax no matter what, but there might be some way to carry forward this loss, or there's some kind of write-off that can be some percentage of it perhaps, or how exactly is it treated?
Again, the question is it going to be a capital loss, in which case that Bitcoin asset was held for investment purposes, or is it an ordinary loss? You really have to look at the facts and circumstances. It's that complicated. Frankly, I did have to look into this for someone once, and it took me hours to get to an answer.
One last thing about this issue, and then we can move on to the next part of the presentation. But what exactly is the line between a normal loss and a capital loss, and how you say the capital losses can be carried forward indefinitely? How about the normal losses? How does that work?
Well, a capital loss would be. The question is, how did the taxpayer hold this asset? Okay, if there's someone who purchased, now to step back a bit, basically everyone except an exchange or someone who's in the sole business of buying selling Bitcoin treats those trades as capital transactions. With those long-term, short-term rules that I explained, a Bitcoin exchange, a Genesis or Itbit or a US one, they hold Bitcoin as inventory, so things are a bit different for them. But so, if you're a straightforward loss on Bitcoin would be if you sold your Bitcoin for less than you'd purchased, right? You have a capital loss. Now, what if, as you said, theoretically, you take $2,000 of Bitcoin, put it onto a paper wallet, and there's a fire, and now your Bitcoin's gone. It's forever. So how is that treated? And again, the question is it capital or ordinary? There's a set of rules. It would basically depend on how that was treated and what your intent was when you would acquire this asset. Did you buy this Bitcoin for investment purposes, planning to hold it and sell it later, or not? Chances are, if you're an individual, this was for investment purposes, because a person is not going to hold inventory in most cases the way an exchange would. To go back to what would constitute an ordinary loss, the rules on this are what's called casualty or theft losses. So, and the idea of those rules is for situations like there's a hurricane and there's a flood and my car is gone and I lost my car and I lost 50% of my house. So, the fair market value of my car is $20,000 and my house is gone completely. So I lost $350,000, say. And so I've got a car for $20,000 and the insurance company reimbursed me, but I'm still out $50,000. So I got a $70,000 loss due to, it's a casualty loss, okay? And again, it could be theft. What if someone stole the car and flooded the house? So those are going to be ordinary losses, okay, because of those circumstances, as opposed to a capital loss. I hope that wasn't too long an explanation.
So just to clarify, then the ordinary loss cannot be carried forward infinitely. Like, how exactly is this ordinary loss?
Wow, that then gets really complicated because there's a different, but probably not, because the ordinary loss, in order to carry forward the ordinary loss, you would need to end up going negative on your total income for the year, which would create what we call a net operating loss. But it's darn unlikely to ever happen. I've never seen that, and I've been doing this for 15 years. I've never seen a situation where someone had a large enough ordinary loss on a casualty or a theft such that it completely wiped out their income. It can lower it, but not wipe it out completely. More commonly, what you can see is for someone who's a business owner, and they had a bad year, or it was an early, say second year of the business, and they were not yet profitable, so they have an overall loss because due to business, and that would be ordinary. But specifically, what you're seeing here, I've never actually seen that one happen, and I hope not, because that would really suck.
Yeah, I mean that's the thing. In Bitcoin, there are cases where people get scammed or hacked, or major issues happen, and that actually the losses are significant enough that they would exceed a normal annual income of a working person. So there are some, they're not that common, but it's not unheard of either.
Okay, got it. Yeah, I mean, and the first thing that comes to mind is Well, we had an Alcan exchange in Florida blow up earlier this year, didn't we? And I think there's a lot of freaking unhappy people who thought they were in possession of approximately $4 million of Bitcoin and various altcoins. So, yeah, I understand these things unfortunately can and do happen, and unfortunately the world's full of thieves, and some of them, they're in Bitcoin, unfortunately. Boy, do I hate thieves. I guess the short answer is it certainly is possible, and then we basically would have to go back to facts and circumstances to determine the character of the loss, if it's going to be ordinary or capital, and that would require an examination of the facts and circumstances and some research to see, and everything else playing out on their return too. So,
okay, I think that covers that part quite well then.
Sure.
So you can move on to whatever other part of the presentation you would like.
Yeah, sure. I mean, I have I've got plenty. I've got plenty more to go. It just depends, how much detail you want to go in. We still been focusing mostly on, on the trading of Bitcoin. I'll tell you. Sorry, I let my button up. Let's talk about some of the foreign issues here, because I think that this is a major issue for some of the people on stake pool. And specifically, let's talk about the FBAR, the Foreign Bank Account Report, and FATCA, the Foreign Account Tax Compliance Act. What both of these set of rules are apply to assets that are held outside the United States. And they both have really serious fines for noncompliance. A foreign bank account report, if you should have filed that report and you did not, and you can have a penalty. You could be looking at $10,000 a year, and then it goes up from there. The trigger to file a foreign bank account report is an aggregate balance of $10,000 during the year. And I'll dig into in a moment how we get to that and why it could apply to Bitcoin and why it might not. And it's not that clear. So let's say I worked in Germany for a while and I had a couple of accounts there and I left the money there when I left. And during 2015, one of these accounts had a max balance of $5,001. That's the high balance in that account was $5,001. And the second account had a high balance of $5,000. You add the high balances of the two accounts together, you have $10,001. Therefore, you need to file a foreign bank account report and report certain information to the U.S. Treasury Department because you're over the $10,000. So that's what triggers the FBAR, the Foreign Bank Account Report. Now, until fairly recently, this was a voluntary report with heavy penalties for noncompliance, and there was no system in place to confirm that people were actually filing the FBARs that they should have. It was voluntary. About 10 years ago, UBS Bank was caught. There were a number of employees in the United States, and it came to light that they were actively helping U.S. citizens avoid U.S. taxes and by hiding their money in Switzerland in U.S. bank accounts. And they were breaking the law, and they got in an awful lot of trouble about that. And the end result of that dispute, which became a full-scale diplomatic dispute between the United States Treasury Department and the Swiss government, is the Swiss government's banking secrecy cracked. The U.S. Treasury Department forced the Swiss government to give up a list of names of several thousand people who held money in those accounts. And then the U.S. government went after those folks for their refusal to comply with U.S. tax law. So what was the end result of this was Congress realized, hey, wow, look at all these people who have been hiding their money. We're going to pass a law to make everybody comply. So they passed FATCA, the Foreign Account Tax Compliance Act. What this law does is essentially it takes the United States laws and forces banks in the rest of the world to comply with the U.S. law by for any U.S. citizen or green card holder, they are required to forward certain information about their accounts directly back to the Treasury Department. And there is now a huge database system as part of the IRS and the Treasury Department that receives data feeds from banks all over the world to report the balances in those accounts. And soon they will also be reporting the income. So that's some background about the FBAR and the Foreign Account Tax Compliance Act.
Okay, I just have one question which you might be addressing soon. But what exactly counts then as a bank account?
Very good question. And the answer is it's a very broad definition. And it doesn't specific for, and they're not the same for FBAR and for FATCA. For FBAR, the reference there is a foreign account. Okay, so the first question is, well, what's an account? And the answer is, well, it's a pretty broad definition. Now, that can cover anything from a checking account, a savings account, owning a foreign mutual fund held by a foreign broker. And the question I think we may be asking ourselves here is, well, what if you have Bitcoin in an account in a non-U.S. exchange? Is that a foreign account? Kind of looks like it, doesn't it? You send your Bitcoin. Let's talk about Bitcoin purely for a moment. You send your Bitcoin to a financial institution. They hold your funds. They have it in a numbered account, and you can control, and they hold it for you, and you tell them to trade, and they trade, right? So kind of seems like a financial account, doesn't it? Now, here's the big issue, though. The question is, if you have Bitcoin and purely Bitcoin or other virtual currency in an account outside the United States, do you have to file an FBAR for this? The IRS and FinCEN, because it is the Financial Crimes Enforcement Network that handles the administration and issues all the regulations about FBARs, they have issued a very small amount of information about what you're supposed to do here. They did state, though, that the virtual currency itself does not need to be reported on an FBAR. Now, I have contacted the people at the IRS that are in charge of this, and here's the thing. Number one, they have never had an official communication about their position on the FBAR issue. The information about that was provided almost as a side comment in a webinar that was given to accountants by a particular employee of the IRS. And then the press followed up and said, whoa, what are you doing? So they've never really issued a formal written statement about what their policy is, okay, which is a little unsettling. Though they did say, no, you didn't need to do it for this particular year. So, yeah, they made statements, but they weren't in a written pronouncement. They weren't in a regulation. It kind of seemed that they haven't really decided how to deal with it, so they kicked the can down the road. Now, so the other issue, so that's one issue. Well, here's some other things to take into account, and I was thinking about this earlier today. If there's anybody out there with an account with Bitstamp, as you probably know, has applied for a New York State bit license, and Bitstamp, if you held an account with them last year, you ended up, and you have a U.S. address and information from your ID papers that identifies you as a U.S. resident, you got an email from them that said you need to provide us with all of your information because we are going to comply with the FBAR and FATCA rules. So what is the answer on that one? It's not abundantly clear. Okay. So there's that aspect. The other aspect is I'm speaking particularly about holding just the Bitcoin. Now, what about the cash? Well, that one's pretty clear. Okay. So it is uncertain as of now because I have seen not a single word about this from FinCEN or the IRS, what the reporting requirements are for this for 2015. But if you send cash, fiat, dollars, euros, yen, yuan, whatever, to a non-U.S. exchange, that is definitely going to be foreign currency under FBAR definition, and you damn well better report that on your FBAR, because if you get popped, you're looking at 10 grand.
So as long as your balance is being displayed in some currency, then it's essentially an account that is, and it's with the foreign entity, then that satisfies the requirement.
I'm sorry, could you repeat that, please?
So even if you, let's say, I mean, you don't necessarily have to have a bank account, but if you have sort of a balance at an exchange, whether they're regulated or not, or if they're under the jurisdiction of the of the U.S. Regulators or the IRS, then they would have to. You would have to, as long as you have a fiat balance, then you have to report it.
Yes, you need to report a fiat balance, and I've done this for someone who had a fiat balance at a non-U.S. Bitcoin exchange, and that's really clear. But again, the trouble with this is it isn't so clear, because dollars are clearly currency. They clearly fall into the FBAR rules. So fiat currencies, which is a term we use in Bitcoin, yes, clearly clearly a currency. But it's easy to see how you can end up with fiat in an exchange. I mean, you could just wire $10,500 to Bitstamp. That puts you over the $10,000 limit. There's a clearing process. Then you can convert your fiat into Bitcoin. So, even if your fiat's in there for a day, then you ought to file that report, because again, the financial consequences if you do not are large.
So essentially, and it's not for only it's not 10,000 per exchange. It's just that overall in all your foreign accounts, or what would be considered foreign accounts, if you at any point reach a balance that exceeds a value of 10,000 US, then you must report it for the year.
That's correct, and I would just add that it's the high balance in each account. So if someone had $5,001 on local Bitcoins, well, they wouldn't have fiat over there, would they? So am I right on that? You wouldn't really have fiat and local Bitcoins, only Bitcoin, correct?
Right. Though, I mean, it doesn't. We could just use any example, but just for the purpose. But yeah.
You had $5,001 of fiat in Huobi, and then you had $5,000 fiat high balance on OKCoin. That's $10,001 because you're adding the high balances together, and therefore you're over the 10,000 requirement. You have to report it, whether or not the exchange that you're involved with has any relationship with the U.S. Treasury Department or not.
Okay, and it's at any point in time, right? It's not like if you have 5,000 in one account and you move it over to another, then you had 5,000 in one day and 5,000 the next day. It's two separate, so it doesn't count as one.
Yeah, I think I followed your question. The high balance is calculated per account, and then then you take the high balance for each account.
Okay, so it's at any point in time it has to exceed 10,000.
Sort of. I mean, if you have two different accounts and you have 10,500 in one account, let's say you have $6,000 in account 1, and then you transfer that same $6,000 to account 2. Your high balance is going to be 12,000 because you have two different accounts, each one of which had a high balance of 6.
Okay, so then you don't actually have to have a total of 10,000. You can actually have just, say for example, even just $1,000, and then you move it around to 10 different accounts in the same year, and you have then a high balance that exceeds 10,000, even though you only have a net worth of $1,000.
It's entirely possible, and in fact, I had to take a hard look at this problem once for somebody, and I looked at this as hard as I could. And I came to the conclusion that there really was very little guidance to in reference to transfers between accounts. So being an accountant and needing to take a conservative position with the lowest amount of risk, my response is we just report the accounts. Now, again, keep in mind that an FBAR requirement is simply reporting basic information about the account, your name, Social Security number, bank, information in the high balance. It's not connected to the income, so it's just an informational statement that needs to be filed. so that the IRS knows that, yes, this person with this Social Security number had this money. The reporting for the income of that is going to be completely separate. Now, of course, if they see you have a foreign account, they might, they may think, well, gee, there's some income there as well.
Okay, I think that's pretty clear now then.
Thank you. I guess I was kind of thinking at this point that, we're about an hour in at this point. Maybe I can kind of just address some of your questions before, because there's plenty other things I can discuss, but I kind of wanted to, the highlights would be the biggest area of exposure for anyone who is holding Bitcoin or doing the types of transactions that traders do is your foreign bank account report, because it's the most expensive problem to have. And the other issue, of course, is making sure that you accurately track and report all the income that occurs from the trading, whether that's in the United States or out. So those are there's two issues there. One is making sure you don't have unreported income, and the second one is making sure you meet any FBAR requirement, being conservative about it, because it's an expensive problem.
So more or less just report it all.
Right. I'm saying be conservative. If we're not sure, and you might as well just report it. It's not going to hurt you. So, in worst case scenario, okay, you report an account you don't really need to, but you need to report all the income anyway, so it doesn't really matter too much. You're not going to be hurt by fessing up and reporting an account. This is not something where you want to be aggressive. You want to be real conservative.
So a U.S. trader would actually have to report all of their income, all of their foreign bank account, and all of their trades that they make. All that has to be reported to the IRS.
That's right.
Wow. That's so. Okay. Well, what about? I know there's the issue of mining was one question that we didn't hit on that people were asking about. Maybe you would like to talk a little bit about what taxable events arise in the process of mining. There are people that are part of mining pools. And there's because Bitcoin is a global peer-to-peer protocol and network. There's a lot of nodes that are foreign, which are relaying transactions and how that affects things. And could you talk about the mining in general?
Sure, I'd be happy to talk about mining. In fact, mining is actually a lot simpler. One thing I did just want to throw out there are just some tools for people to use to sort out their trades and their Bitcoin income. So I'm just going to mention two companies, one of which is LibraTax, LibraTax.com, and the other one is Bitcoin.tax. These are both platforms where you can import your information from different exchanges, or whether they're in the U.S. or outside the U.S., to help you calculate what happened there. And I'll just mention them because there's only really two tools to do this, and they can also be used for other cryptocurrencies beyond just Bitcoin. And I just wanted to mention them because they're important tools. I also would like to mention that I am in the referral program for LibraTax, and that I am also listed on the website for Bitcoin.tax. So I have concretely received some business from LibraTax, and I did want to disclose that, but at the same time, there's really only two platforms, period, that can do this. Hello?
Yeah, could you dig though a bit into what taxable events are arising in the mining process? Or
certainly, mining is actually fairly simple. Forgetting about pools for the moment, if someone buys a Bitcoin mining computer, the IRS says that your income from this activity is equal to the dollar value of Bitcoin that you receive each day. So the miner's running 24 hours a day, and let's say, I don't know, you're getting a tenth of a Bitcoin every day. Your income is equal to the dollar value of the Bitcoin you receive each day. Whether or not that Bitcoin actually gets converted into dollars, you're required to pick up the dollar value of that each day.
Okay, so that's quite straightforward, isn't it?
Yeah, it seems simple, but what I kind of talked about is this, a straightforward situation. You buy a few miners. If this rises to the level of a business, then the Bitcoin that's received each day is the revenues for the business rather than simply the income. Since the business will have other expenses, it has to pay for electricity, which of course is the biggest cost for miners, and the equipment itself is also going to be depreciated over time. But the basics of mining are not that complicated. The reality of tracking this and what wallet all this Bitcoin went into on a daily basis is not always so easy to deal with.
Okay, so I mean, we hit on most of the points that the community was interested to hear about. Unless there's anybody, any of the active users that do have talk power here, does anybody want to ask Mr. Winters any questions that you had in particular?
We didn't really touch on altcoins too much, but I understand that. Right, altcoin trading; those are all taxable events. Now, if you don't maintain adequate records of those transactions, I mean, what all goes on there? I know like Bittrex, routinely loses our trade history. So how does that come into play?
Thanks. Good question. And it was in the back of my mind that I wanted to make sure I talked about altcoins because there's clearly a lot of other cryptocurrencies out there. So, I mean, and the one thing that's probably on a lot of people's minds right now is Ethereum and the Ether token, right? Basically, as you said, when you buy and sell... Oh, shit. Hello, can you hear me? I'm afraid I lost my internet for a minute.
No, we heard you the whole time.
Okay. Someone's saying we're done with Ethereum, moved on to Lisk.
No, it's just...
Yeah. Well, my answer is if you're a U.S. citizen or a green card holder and you're buying and selling Lisk, the rules work the same way as they do for Bitcoin or Ether. Long-term, short-term, track your cost basis, track your sales proceeds. But to go to the question, if you said, well, the exchange you're using lost the records, well, I guess the simplest thing to say is that's problematic because you do without records, it's pretty hard to figure out what happened, right? Got to do your best to reconstruct the situation with the data you have.
Anybody else out there who has talk power from the community, feel free to ask. Now is the time to get some the opinion of a tax expert, especially if you're US based. Now is the time to ask.
You kind of glossed over mining a little bit. You said it's simple if you're doing it for yourself, but not if you're doing it for a pool.
Sure. Thanks a lot for bringing up mining. Why don't you throw out a more specific question? You're talking about pooled stuff. So
Yeah.
What's on your mind?
Just say I'm mining for a pool. Is there anything else involved? I'm getting paid by the pool, and I'm mining to it.
Okay, so you have miners, right? And then, therefore, the hashing power that you own and you physically possess in the facility, wherever it is, that gets pooled with another mining pool, with a pool, and that then you get when the pool gets a block of 25 coins, then you get your fractional part of those coins based on your contribution to the pool. Did I get that right so far?
Yes.
Okay, so then, therefore, the Bitcoin that you receive, your income is going to be the dollar value of the Bitcoin you receive each day. Or when it's cashed out. I mean, you may not, some people only get it set up to get their coins once a week as opposed to every day.
If I were to mine to someone else's wallet address, am I responsible for any taxes?
Well, you're kind of moving things. You don't have to answer this, but why would you want to mine to someone else's wallet? And wouldn't that mean that you're using your electricity and hash power and then giving it away?
You know, paying them for something in a roundabout manner.
Okay. That's a level 2 question. I never got asked that one before. So you're paying someone back by using your miner to generate Bitcoins to pay them back. That's a novel thing. Yeah, that's a level 2 question. Sorry.
Oh, it's fine.
Yeah, sorry. That's sort of the best I come up with that one. So you're in this situation. You're mining, but you're not actually. It's going right to someone else's wallet. So you're really just like repaying money that's owed. It's kind of hard to say it was your income because you never had it, right? But on the other hand, didn't you yeah, again, it's a level 2 question. I mean, didn't you control it? I mean, it's the same way as like
mining to a pool is the same way as well.
But it's but isn't it going the other way though? With a mining pool, you end up receiving Bitcoin. In this case, you're just taking your hashing power, right, and generating. Now, are you doing with just the hashing power or the Bitcoin itself? Because I know that there are sites out there where you can take your hashing power and you can sell your hash power to a site. Correct?
I'm not familiar with that.
All right, I spoke to one person that was in that spot where you can buy hashing power, similar to like a cloud mining site, and at the same side, there are also people who sell their hashing power to that site.
Mining contracts, yeah.
Right. But I'm talking about the other side of cloud mining, which you're paying X amount of money up front to use someone else's hash power, and there's sites that do that, and there are some that are good and there's some are bad. But the other side of it that this guy explained is apparently people could actually sell their hash power to a network. But again, anyway, I don't want to digress. But yeah, you kind of have a level 2 question.
Mr. Winters, you had mentioned before that it might be a little bit too complex, but the futures markets. Can you give us any insight on that system?
Yeah, when you talk about futures, and I had a discussion with someone about this fairly recently, it's just really a level 2 or even level 3 question, because when you're talking about futures, it's simply a complex area of tax and financial law. It's really a bit too much to get into, today. Suffice it to say, though, and in the big picture, although the futures contract may be for Bitcoin, you need to look back at the dollar values of all this because the IRS doesn't know from Bitcoin. And, it wouldn't be, I think, conceptually, it will be the same as, well, what if you had an account in Japan and then you're doing futures trading on a Japanese stock market with yen, right? So you need to know the dollar values. Of course, the difference being that the Japanese yen is a foreign currency, and Bitcoin is not a foreign currency. It's property, not currency. That's my answer.
So in general, there's probably not any tax advantages to trading Bitcoin futures rather than margin or anything like that.
I can't even answer the question. It's just too complicated. I would really have to have a detailed discussion with someone about that in order to review all the facts and circumstances and how things work on the exchange before I could delve into it. It's just way too complicated. And plus, I mean, there's my liability to be concerned with it that, I'm giving a seminar for you guys basically, and I have to be real careful not to get too detailed because, you know, if something happens and then someone follows my advice and it goes wrong, I don't want to get in trouble.
Yeah, sure, no problem. We totally understand that. Are there any other questions from the people with talk power that would like to ask?
Yeah, I have a quick question. With regards to these decentralized marketplaces, if you're selling, say, a service on one of these decentralized marketplaces, you don't necessarily know where your customer is. And being in Canada, we can't provide, if they're outside of Canada, we don't have to charge sales tax on it. But if we don't know where they are, then we're forced to charge the full 15%. Is there a way to deal with that, or?
Unfortunately, I'm a U.S. tax accountant, and I'm not even that familiar with the Canadian rules.
Well, how would you deal with that in the States then? If you're selling on this, say you're selling your tax services. Well, I guess that wouldn't be the same case. You got to know where they are.
Right.
Say you're selling a service that you don't necessarily need the customer's shipping address or where they live. How would you handle that in the U.S.? Would you guys, again, just be forced to charge tax on that?
It's a state-level question, so you have to look at to see what the rules are for the particular state. New Jersey and New York have both issued guidance about the sales tax obligations for merchants who are being paid in Bitcoin, and they both said, well, if that transaction would normally trigger sales tax, if someone was paying in dollars or a credit card, then the fact they're receiving Bitcoin doesn't change things, and you still have to pay sales tax on the transaction. But it's a state-level issue, and every state is going to have a different answer.
If you're providing services to somebody outside of the U.S., do you have to charge them sales tax?
The answer in my case is because in the state of New Jersey, if you're providing professional services, you don't have sales tax, so I don't need to worry about it.
Okay, I got you. Yeah, they changed that in Canada on it.
Stinks, huh?
It does.
Sorry I couldn't be more help there, but I mean, there's the big picture. I mean, there's precious little guidance from any states about this, and even from the IRS issued a fairly, a not lengthy notice saying this is what we have to say about this, and see the rest of the tax code for anything we didn't, directly address. Most states have said nothing about how they handle Bitcoin transactions.
Okay. Yeah, it's not an easy one. I haven't got a clear answer from anyone, even accountants up here. So
there you go. Exactly. I mean, you guys are on the cutting edge. Okay, you're out there like every day in the trenches doing stuff. Okay, because and the fact is, Bitcoin and blockchain, as technology moves so quickly, that it's. I mean, you can just fling Bitcoin around. I mean, you can whip it around the world and run it through a bunch of different wallets, and then end up back on your phone at the end of the day. Okay, but once it stops, then it's like, well, wait a minute, what the heck was my income from that whole round trip? And frankly, I didn't even get into this, but if you're just transferring funds from one wallet to the next, there is no taxable event. It's just no different than taking money and moving it from your checking to savings account. The one thing I will say is that if you're a wallet with Coinbase and you do a lot of transfers out, well, be real careful when you look at their report at the end of the year, because whenever the Bitcoin leaves their wallet, they consider it a sale, and it's up to you to go back and delete out anything with a third-party tool to make sure that doesn't get counted as a taxable sale.
Oh wow, that's interesting. So Coinbase actually by default assumes when coins are leaving your wallet with Coinbase that it's a sale for tax purposes.
That's absolutely correct. Yeah, and that's why the report that you get from Coinbase, if you have any transfers, you better take a hard look at it, because if you take that same information and throw it onto your tax return, you could be overstating your income, and nobody wants that.
Okay, that's a really important warning to anybody out there that's using Coinbase. So let's give one more question, and if anybody that has talk power has any pressing matter that they would like to ask Mr. Winters on regarding taxes? Last call, nobody? Okay, so was there any other sort of topics you would like to touch on before we wrap it up, or?
Well, I pretty much covered most of it. The one thing I didn't really get into too much is, well, what if you're getting paid in Bitcoin and that you're working and providing services and you get paid in Bitcoin? That's a little tricky, and I'll tell you why. And I have some clients in this type of situation where they were providing services and they got paid in Bitcoin. So let's say I'm a software developer, I do a project, and someone sends me $1,000 of Bitcoin. So I now have $1,000 of income, and it's going to be self-employment income because I'm not an employee, I'm a contractor. So I receive $1,000 of income, and it goes into my wallet. So that's the simple part. I have $1,000 of income. Now, if I convert that Bitcoin into dollars immediately, and I cash out the whole $1,000 in the same day, I have a transaction in of $1,000 of Bitcoin, I cash it out to dollars, maybe I use the instant exchange option in Coinbase or BitPay, so it just whistles through. Well, I don't have a gain or loss on this transaction, right? But let's say I like holding on to my Bitcoin because I think it's going to go up. So I receive $1,000 of Bitcoin. I now have a $1,000 capital asset that I hold, okay, with a cost basis of $1,000, and I wait 2 weeks when the price goes up, and then I sell $500 worth. Or let's say I sell half of it. It was worth $500, now it's worth $6. So what do I have here? I receive $1,000 of ordinary income on the Bitcoin that was transferred to my wallet. 2 weeks later, I sell half of that Bitcoin for $600. That had a $500 cost basis. 600 minus 500. Now I have to report a $100 capital gain on my tax return because Bitcoin's a capital asset.
Okay, so that's a good example that sort of demonstrates both parts of it, the way the Bitcoin is taxed in.
Exactly. Yeah, exactly. And yep. So it's a two-step process unless you're cashing out right away, and most of the time people don't cash out right away. So it's just an additional complication.
So then the lesson for everybody is to keep very good records and report more or less everything.
I think that is the biggest takeaway. Yeah, one of the big is right. Keep accurate records, and you know, when you're going and looking back, 9 months or 6 months later, it can be awful hard to piece things together. And even worse, sometimes exchanges blow up, or someone mentioned exchanges give cruddy records. So I would encourage you that, when you're doing your transactions, throughout the day or the week or the month, download your information on a regular basis just in case that exchange either blows up, which would be really bad, or their records just aren't that good. So, yep, you're right.
Great. Well, I think that covers everything. I mean, we really appreciate you coming on and talking to us about these tax issues, and especially answering our questions throughout. We really appreciate everything.
All right. Well, thanks a lot, guys, and hope the market picks up a little bit. It's been kind of going sideways lately, but I suppose there's always ETH, right? Have a good one.
All right, thanks a lot.
Be
Bye.
part of the ever-growing Bitcoin and FinTech community. Go to www.stakepool.com right now.